Hi, welcome to the Macro Show. We talk macro, and you wonder, will the crypto crash lead to a tech wreck? Now, you might not be overly interested in cryptos, but wait till you see these charts on Bitcoin. It may be telling us something bigger in the market is coming. You'll want to stay tuned for that. We've got economic data coming out of China telling us the Chinese economy is slowing down, and when that happens, it flows to the rest of the world. Inflation, watch out. Deflation may be coming. We've got Fed speakers. We've got shadow federal funds rate. You're going to find this real interesting. You can see the actual effects of quantitative easing. We've got hedge fund manager positioning. We've got Treasury data, foreign Treasury holding data from March, telling us perhaps that was the peak in yields. Wait till you see that. And then last but not least, we've got the big short too. That's right. Will Dr. Michael Burry make a big splash with his latest big bets? We'll save that for the end. All right, let's talk about our headline story. What's going on with the crypto market? You know, we don't talk about that almost ever on the show, but I was looking at this over the weekend, because a lot of people talk about how crypto is a proxy for market liquidity. Some people say it's just a non-correlated asset class, and I'm beginning to believe that perhaps it's an indication whether financial conditions are tightening or loosening. And I think they're tightening a lot. And I want to show you this because this is really cool. So this is a chart of Bitcoin. And what we're going to do is we're going to go over here and overlay a chart of Bitcoin so we can go look at it in relation to other things. So put in /BTC for Bitcoin futures on mine, and you can do this on whatever program you use. And we know that there's some relationship to tech. So is this drop here in Bitcoin telling us that tech stocks are going to blow up? Well, one thing we can do is we can go look at Tesla. Now, why would we look at Tesla? Because, well, they're one of the few companies that publicly stated they have a lot of Bitcoin, and perhaps they're tying their fate to the direction of their stock price to tie into the direction of Bitcoin and other cryptocurrency. And you can see there's somewhat of a relationship here, and it would make sense given how much Bitcoin Tesla owns. But what does that mean for tech stocks? Well, let's go to the Qs, QQQ, and we can see over the last 6 months, well, there is somewhat of a relationship here. And it kind of then makes you wonder, is, really Bitcoin a derivative of the tech industry? Well, it could be, but maybe let's dig a little bit deeper. Is it telling us that financial conditions are tightening? Now, how do we know financial conditions are tightening or loosening? Well, simple. We have to go to the bond market. And when yields are falling, it tells us financial conditions are tightening. And when yields are rising, it tells us they are easing. So what, if any, could there be a relationship with Bitcoin and Treasury yields? Well, check this out. This is, of course, where I get interested in it is, wow, look at over the last 6 months, this is 10-year Treasury yields. And what is Bitcoin telling us? It's telling us financial conditions are tightening. You can see it's headed down here, and yields look like they've had a fairly decent relationship. Now, if you go back much more than like a year, you don't see this because it's almost as if Bitcoin was coming into its place in the financial system, and definitely over the last 6 months, maybe a little longer, it did. And you can see the relationship. Let's go to 30-year yields. And you think, wow, look at that. If Bitcoin is correct, if it indeed is telling us financial conditions are tightening, that means yields are headed lower, stock prices are headed lower. And that's pretty interesting because, when I think about Bitcoin, as someone in America, if I were to buy it, I'm exchanging dollars for it, which means if the counterparty of that trade doesn't want dollars, then those dollars I put in have to get sold on the open market to buy whatever currency the seller needs. So on one sense, you think that a lot of people from America buying Bitcoin and other cryptocurrencies would put downward pressure on the dollar. And well, sure enough, we can see that. We can go down to DXY, but you're going to say, well, it's not really inversely correlated. Well, it wouldn't be really inversely correlated because there's a lot of other currencies at play here. And if this is indeed correct and what we're seeing in the bond market is telling us, then that means the dollar's likely to head higher. And that would be indicative of tightening financial conditions. What would you expect to see? You want to see if the dollar gets stronger, bond prices go up, yields go lower, and stock prices go down. And so that's kind of what we're seeing here. And I find that extremely interesting because if this is true, and I assume over the next several days or more, we'll see where Bitcoin goes. but it could be leading tech stocks lower and telling us financial conditions are tightening, which is not a sign the market wants, because the market's hopped up on inflation, right? It's telling us, oh, financial conditions are easy. There's all this money sloshing around. And Bitcoin's saying, nah, it doesn't appear that way, but we'll let the market decide here. We'll keep an eye on that maybe for next show and keep watching, see where this is going, see how the market reacts to that. Now, last week I had the opportunity to sit down with the guys from not Wall Street Bets, but Wall Street Silver. I knew I was going to get it wrong, so Wall Street Silver, and I'll put this in the description below for those of you who want to take a look at the interview. It was a lot of fun, great guys, and if you're a fan of silver, or maybe just want to see what I had to say, go check that interview out. Let's go on to the Sunday night data. And what do we have out of Japan? Month over month, producer price is coming out of the factory up 0.7%. So that's a pretty big number. And of course, what would you expect to see? The year over year rate react to that from 1.2 to 3.6%. So definitely showing, higher prices coming out of factories in Japan, factories coming out of the factories in Japan. Looking at South Korea, preliminary exports and imports, 41%, almost 40%. These are all heavily due to base effects. So nothing to get excited about that. But let's go into the data out of China, because there is some interesting stuff here. One of them being industrial production slowed from 14% to 9.8% in April. So if we look at industrial production here in China, and you can see this base effect here back in April, so it would make sense. But what's odd about this number is it fell to 9.8, and typically the number, pre-pandemic was running around, high sixes and high fives into just barely at 7. So the fact that your April print was way down here from your base effect, and we're slowing down to 9.8, tells us that the industrial production out of China is indeed slowing, and that perhaps once the base effects get caught up in the months that follow, that this number may actually fall below trend. And we look at the same thing with retail sales. On a year-over-year, went from 34.2 to 17.7. Now you say, wow, but 17.7. Look at the base effects. So here's the retail sales, and the base effects from April were way down here, way down there. So it's showing that retail sales are rapidly cooling off. And in China, and what's their normal level? Well, they're pretty consistent in the mid 7s to mid 8s, and it's slowing down pretty quick. And it's got a couple more months of base effects to keep it higher. And then after that, it looks like it's going to potentially, fall below trend. And, when China slows down, well, that tells us the rest of the country is slowing down. And we look at the credit impulse, and we see the producer price index out of China lagging by 9 months. And so credit, obviously this is borrowed money. China is a kind of controlled economy, planned economy by the government, and credit impulse is turning negative. So that tells us that the Chinese economy is slowing down. And when Chinese credit turns down, so too does the rest of the world. And we can see that in their money supply data, which isn't like the U.S., which is running off the charts. It's running at 8%, which, normally in the U.S. is a, pretty solid number. But look at China. The last time it was 8%, it was 2018 to 19. So again, it's telling you that credit growth, money growth in China is decelerating, and that has knock-on effects around the rest of the world. And here's some China credit impulse. The charts are a little harder to read, but we had 6-month credit impulse here in green, so it's way down. And then I don't like the fact they're using percent change in 10-year Treasury yields 3 months prior versus 3 months to the right. And what that's telling us is that 10-year Treasury yields are likely to, as we know, head lower due to the change in China's credit impulse. So interesting stuff coming out of China, telling us that perhaps this inflationary story, this global growth story, is not going to last. All right, let's look into what do we have in the Eurozone. Italian CPI, April, up 0.4. So, normally 0.4 is a little bit of a hot number, but not, like a 0.7, or 8 or some bigger number. And look at the year over year inflation, only up to 1.1 in Italy. So you can definitely see that inflation is not running wild there at all. And moving into we got some Canadian data in April. Housing starts slowing down from 335,000 down to just under 369,000. So perhaps a sign that the Canadian housing market is slowing down. How about the New York Empire state manufacturing index went from 26.3 to 24.3. What does that mean? Expanded at a slower rate. So these things are starting to matter in terms of showing the economy is not continuing to accelerate at the same rate. It's the momentum is slowing. How about the housing market index in May? Unchanged over April. And we're going to take a look at the foreign bond buying here toward the end, so we'll look at that in a little bit. Let's move on to Vice Chair, who we have here, Richard Clarida. He said in a Q&A after his speech at the annual Financial Markets Conference, this was today, that we have not made substantial further progress on the central bank's goal for employment and inflation. So what he was referring to is not enough progress to start the talk for the taper talk. So that would be out. Now, this was sent to me by a fan. I have not seen this before. This is really cool. This is from the Federal Reserve Bank of Atlanta. This is a shadow federal funds rate. And what this tries to determine is what it actually is. So unlike the observed short-term interest rate, the shadow rate, first introduced by Fisher Black in 1995, is not bound by 0%. Whenever the WUZIA shadow rate is above 0.25%, it is exactly equal to the model implied by 1-month interest rate construction. So what does it show us? Well, it shows us the shadow rate is minus 1.8%. Now, I want to show you what quantitative easing does. So remember back post-Great Financial Crisis, the federal funds rate was a 0, which is this blue line that you can barely see because it's sitting right on the 0 bound. But see how this green line goes down, down, down? That's the quantitative easing. When did quantitative easing end? 2014. So we had QE 1, 2, and 3 through here, and now look, QE is back. When did QE come back? Right, in 2019, and look what happened. And now we're still driving short-term rates negative. This is exactly what quantitative easing does, and I was so happy to see this. And so again, thanks to the fan who sent that to me. Greatly appreciated. Let's take a look at hedge fund managers' positions, and we see they are very slightly net long the 10-year. So putting some more indications that perhaps the peak in yields is in, as we've discussed. And looking at the 30-year, they're backing off their short positions. So we'll look at it in a little bit. One hedge fund manager looks to be all in on this trade on the short side, and maybe not have the same effects, hero effects that he did in the Great Financial Crisis. So we see speculators kind of backing off their 30-year shorts as they're starting to perhaps believe that peak yields are in as well. Still got a long ways to go before the bottom. I mean, they got to get wound out all the way to the long side and get really squeezed out of those positions. WTI unchanged for crude oil. No big moves out of the hedge funds positioning, and it's no real change in S&P futures. They're still net short. Euro futures up. This could be driving some of the pressure, driving gold up and keeping the dollar down. Let's take a look at gold. We see futures up last week, and we're seeing that driving again today. I do have some information on what could be a catalyst for today's move, but unfortunately it is non-public information. I'll share it with you once the time has cleared on that. NASDAQ, we see slightly less net short as tech stocks look to be rolling over, as we just looked at, with Bitcoin perhaps leading the way. In tech stocks, still hedge fund managers are short small caps as they look to be breaking down. We talked about that on the Sunday night chart show. And what do we see with the dollar? Still not a big move, slightly longer on the dollar, but the dollar is just not getting any momentum higher. But that's okay. Well, if what Bitcoin is telling us is true, the financial conditions are tightening, you don't need people to be long the dollar. You could see the dollar took off here, and you didn't need people to be long it for financial conditions to tighten up. You see it here. Didn't need people to be long for the dollar to tighten up. And hedge fund managers slightly reduce their shorts on volatility, which is not a major deal. Let's take a look at foreign holders of Treasury securities. How about March? Massive decrease from 7.098 trillion to 7.028 trillion. Whoa, big drop. And in fact, you've got to go back to between May and June of last year to find out when they had that few of treasuries. So here in March, the biggest selling event in a long time between February and March by foreign holders of Treasury securities. And what is that telling you? What does that mean when you see foreign central banks, foreign governments, foreign investors selling treasuries? it means there's a dollar shortage. They need dollars. That is why they do it. You have to understand that they hold Treasury securities as a piggy bank. That's their savings account to get dollars. So when they need them, they sell them. When they have too many of them, they buy more. So normally people look at this and say, that means yields have to be going up because they're selling. No, they don't want to sell. The idea is they want the global economy to grow. They want to get more dollars and buy more of these things. That's how the global economy works, with the dollar as its reserve. Now, what has happened, let's flip over here and look at where yields are at. And back in March, there you go, potential peak in yields that so far now looks to be slowly heading back lower. And if Bitcoin is any indication, well, the yields are headed quite a bit lower. All right, on to the Big Short 2.0. Of course, we've got Dr. Michael Burry. This came up on Zero Hedge today. Michael Burry reveals massive Tesla short, huge inflationary bet. Now, remember, he's the guy that bet on the housing market and won. Of course, the movie The Big Short was largely about his story. And he's got some massive short positions, and not only he's got some very speculative short positions. He's got 171.5 million puts on TLT and calls on TBT, calls on TTT. He's got 55 million, 4.6 million. He's even got calls on a 3x levered. Wow, Treasury Bear ETF at 3.1 million. This guy's got over $200 million, obviously of client money. Here, outright long TBT at 6.5 million. He is massively betting on inflation. Well, Dr. Michael Burry, let's dance, buddy. I'll take that bet against you. You got the money multiplier in play. We've got QE in play, and maybe now Bitcoin. Same financial conditions are tightening. Anyways, hope you enjoyed today's show. Thanks for being fans. Thanks for watching. Thanks for supporting us. We're getting real close to being able to get Momentum Timer Pro out. Just a few more steps to compliance, and we'll be there. So I'll look forward to having that for you. And unless I got a special show coming tomorrow, which I might, we'll see you on Wednesday for the macro show. Thanks again. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation of buyers selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, person capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial.